So Tim Sire sent me this indicator, a weekly move. And the point is to see if you could figure out ahead of time what is going to be the range of the week's price action given the implied volatility and where the initial price comes out of the opening price of SPY. In this case, it's SPY. And so you see this is a range, and it seems to pretty closely encapsulate the entire range of price movement for the week. So the question is, how good is it, and what are the details relative to what's the delta of these strikes? So what I did is I created an indicator for TradeStation that does the same thing, and these outside envelopes here are basically the same thing as what Tim did with the Thinkorswim platform, but I converted it, coded it up for TradeStation. I can do things on TradeStation that I can't really do very well on the Thinkorswim platform. So for me, it's a little bit easier, more effective to be able to use TradeStation. And so then I decided to say, well, where are these things relative to the delta of the price action? So I created a spreadsheet that took all the data. Here was the data. Here's the data. Here's the date of the data. So the beginning of the week, that's 2021, May 17th, and at the time it's 1 o'clock. The Tim's calculation on this high was $425.49, and the low was $405.29. The delta, I used Thinkorswim's ThinkBack, and I took a look at the delta on that price, on this particular high price. So a call delta would be, at this strike, would be about 0.05. And on the put side, the delta would be a negative 0.2. And then I said, well, what would be the deltas, or what would be the strikes if you would have chosen a 30 delta and a minus 30 delta on Thinkorswim ThinkSback? And so they came up with 419 on the call strike and 409 on the put strike. And then I did this pack for 2 months, and I wanted to see how the Tim's indicator worked, and it looks like it ranges from 0.05 to 0.16. So those are pretty small deltas. So you're way at the end of the price range expectation for the week. And the same thing for the put. You got from 0.2 down to 0.08. So that's pretty low. And you can see that I'm going to show graphically here, what does that look like when you put those two things together on TradeStation? Actually, go back to TradeStation here. Let me go back to TradeStation. So this purple line or violet line is the top of the 30 delta. That's the call on the 30 delta, and then the red line is the put on the 30 with a 30 delta. And you could see how Tim's indicator basically engulfs that for the most part. This particular one didn't quite do it, but for the most part, his indicator pretty much encapsulates the price action as well as the 30 deltas. And if you see that his is a 0.05 to 0.2 delta, you can see that it's pretty much outside the range of the price action of a plus or minus 30 delta. So I'm going to show you what I did with TradeStation here. I compared it to the BBIC strategy that I run, which is fully automated, to basically buy and sell Iron Condors on any equity, and compare it to the 30 deltas. This is the 30 delta here. This is the minus 30 delta down here. And you can see that on the Iron Condor, this is the long put. This is a short put. This is, short call. This is a short put, and this is a long put. So the top ones, the greens are long strikes, and then the reds are the short strikes. And if you look at the overlap between the 30 delta, plus 30 delta, minus 30 delta from the option chains using ThinkBack, you see that they pretty much overlap. There's a few anomalies, few times that it doesn't quite do it, but for the most part, the calculation is pretty solid. And the way that it's done in my strategy / indicator is that it looks back for the previous week. Ooh. Oh, let's do that again. So, oh my gosh. So this is a 30 delta here. All right, and this is a minus 30 delta, plus 30 delta. This is for the Iron Condor, this is a long call, this is a short call, this is a short put and a long put. And as you go through this chain here, this is weekly. Every week I produce a new computation set of calculations to figure out where those strikes should be, trying to anticipate where the 30 delta is going to be for trading an Iron Condor. And it pretty close to matches up with the pricing model used by the option makers, the market makers for the options all along. So if you look at these things pretty closely overlap, there's a few that sort of stick out a little bit one way or the other. There's a rounding thing that I do. I can't get exactly the same strike that the option makers have, as well as what time of day is it? Is it at 10 o'clock or is it 7 o'clock? So there's a lot of different variables, but if you look at, to me, this is pretty close to agreement with ability to go between the, to basically set up the range for my strikes for my Iron Condor through the week. This one was an anomaly. This just had to do with, if you look at the width between the market makers, this was a plus 30 delta, this is a minus 30 delta. So this thing should have come down a little bit, that thing should have come up. This one here, this range is based off of the previous week. So I look at this in terms of a standard error for the previous week. I look at the price action and try to determine what it's going to be for the following week. And so this was very, very tight price action. So it came up with a pretty small standard error, whereas the market makers had a very big expectation on the price action. So their 30 delta was way up here and their minus 30 delta was down here. So I'm trying to decide whether to use the market maker's calculation or to use my calculated based on the previous week. This actually made a lot of good money here when it actually broke out of the range. It did this somewhat gradually, and when it goes through gradually, it actually buys back the short strike and it lets the long strike run. And so you can actually make money on the long strike make 100% on the call side, but then on the short side, on the downside for the puts, you actually make money by selling the put, getting out of the put. And this happens somewhat regularly. You actually have it happen here again. The short put was purchased back, and it's actually better when it's tighter to buy the put back sooner than if I would have waited till the calculations, if I would have used the strikes that the calculations showed for the market makers. So these were the market makers 30 delta, plus minus 30 delta, and mine was here and here. And so mine actually did better and actually made more money. I actually exited on the put down here, which gave me on an Iron Condor, it gave me 107% gain on an Iron Condor because it went from an Iron Condor to a single-ended long put, and then exited out at the end of the day because I thought it was moving too fast. So on the whole, it seems to be pretty good agreement with the standard error. I will continue to use it, but as a backup for people that do not have the ability to do standard error computations over the previous week on 15-minute bars, they can use the computations provided by the market makers, and just when the market opens on the Monday, to look at a plus 30 delta and a minus 30 delta, and that will be your first strikes to be used for the first part of the range, and then choose another strike on the short side down. Usually you make the greatest amount of money with just a $1 or $2 difference down here. So anywhere between $1 and $4 would work fine for most people. I will do it a little more scientifically, but for those that are able to do it with Thinkorswim, this should work as well. Enjoy. Happy trading.